Good evening, everybody. Welcome to Frugal Finance. Today we're going to do a little review of AGNC investment holding. So they're a real estate or property investment company which you can buy individual shares in. So effectively a cheap way of owning real estate or having exposure to the real estate market. So without further ado, please do subscribe, smash the like button, and let's get stuck in. So we're just quickly going to nip on over to have a look at the AGNC website and also Simply Wall Street, because those are two key factors that I would look at when trying to analyse a particular stock. So let's get over to them and have a look. So here we are on the AGNC website. Obviously, you can have a look at their kind of core values and things. So essentially what they are is a real estate company in America that exposes you to basically to property and the ups and downs of that. The main thing with AGNC is that you get a monthly dividend payout, which would, in a way, I suppose, not be dissimilar to the equivalent of monthly rent. So obviously there's a few bits of information here, but news is of particular interest to me. So when you go here, you can see that there are the announcements for the fourth quarter, the financial results. So you just simply click on here, or you can download it as a PDF. Now, obviously, there's an awful lot of information to digest in here, essentially. But for those of you looking for the kind of just a bit of a highlight, really, you can go down here to where it says management remarks. So obviously they're saying in the fourth quarter, AGNC maintained a positive momentum of the prior two periods, generating a 7.5 economic return to tangible common equity for shareholders. So they're saying that they continued their bounce back up to their particular stock price, or they're kind of settled, because remember, this is a settled company in the sense that their stock price doesn't tend to fluctuate too much. It's not a growth stock. This is an established stock paying out a dividend, generally speaking, regarded. And then obviously they touch upon the fact that there's headwinds and so on. And then obviously finally they repurchased 101 million or over 6 million shares of their common stock, so they're buying back their stock. So this is sort of information. I won't bore you with all the ins and outs of it. Please do go and have a read of it yourself if you want to learn more about the company. And obviously you can look at their sort of about our page. They have like a risk management profile, so really about that they're touching on their kind of principal kind of risk appetite, if you like, and who their mortgage-backed securities are being backed by and so on like that. So again, I'm not going to go massively into detail on all of the various positions. Please do have a read of it yourself, but this is the kind of research that I would be looking at to make sure that, generally speaking, from the company's website, that, this is a relatively solid style of company to invest into. The second thing I would be looking at is to look at Simply Wall Street. So we'll just nip on over to that. So Simply Wall Street here is basically a kind of a portal, if you like, for all stocks. So you can just literally just type in the search bar and find them. You do have to sign up, and there's a free account, or you can have a annual subscription fee, and then you can input your portfolio into here. It gives you kind of risk factor and all that sort of stuff and how diversified you are. But for base information, this is a pretty good website, to be fair. So it gives you a kind of executive summary here. So at the moment, the stock is trading 13.4% below what they think is fair value. We'll come on to that at the bottom. And earnings forecast is to grow 93.48%. Obviously, the risk analysis is the debt that they have is not well covered by the operating cash flow, and it makes less than $1 million in revenue. And the dividend of 9.23 is not well covered by the earnings. That is a kind of algorithm executive summary of it. Obviously, you can see here they give this kind of snowflake analysis of this sort of teardrop thing. It's a good dividend, reasonably healthy, and it's got a positive future. Those are the kind of things that snowdrop is pointing to. And then you can really have a look through the information. And one of the things that I would look at is, for this stock, is because it's an established stock and a dividend, I would be looking at the max fluctuation. So you can see here the maximum share price was £36, which should have been around here 2012, that is, to September 2012. And then obviously its low was back here with the start of the pandemic, probably around about $10 or something. I can't quite get that to line up because it's a bit fiddly because the data's over such a long period of time. But we're guessing that is probably around about $10, that dip there. Here we are, minimum $10.38 in the side here. So basically, trading currently at about $15.80, something like that. So, quite far away off their peak and not too far off the bottom. So I'm going to anticipate it's probably a reasonably fair value. So yeah, it's not particularly volatile. It does kind of steady around here. You're looking at the $19 mark until obviously the crash. Then you can read further down. Obviously, share price is less volatile than 75% of US stocks over the past 3 months, typically moving plus or minus 3% in a week. So, relatively stable stock. So you're going to buy it at a price and it will probably stay at that. Obviously, these are the 7-day and 1-year returns, which because of the virus has obviously impacted that. It's a shame that you can't do kind of 1-year return for, an isolated period. So just say like 2018, for instance. Just look at one section. Maybe you can if you have the full app, but this is obviously the free version. Shareholder returns, including dividend returns if you want. Here we are. So, obviously, you've got here that, this has been relatively flat, give or take. And then long-term price volatility versus the market is sitting in the middle, so it's not particularly volatile and not particularly down at the mega stable end and not at the mega high end. So, and the industry, if you like, is further up the high, so it's much more stable than its industry competitors. Valuation here, obviously analysis checks, it's giving 1 out of 6. The reason for that is it's undervalued at the moment, but what they're saying is it's trading below fair value, but not by a significant amount. And then price to earnings ratio. This appears to have maybe gone a bit funny with the app, but you've got here AGNC is unprofitable, so we can't compare PE ratios. So that's obviously giving you all these red X's there. I'm not too sure why it's unprofitable. Perhaps they've lost money in a previous period. Would have to look into that further, or it may be a simply Wall Street error, because they've got future growth here, 5 out of 6. So these apps are not perfect, but they give you a good base information here. Analysis for future growth, obviously it's got much better than the market, better than the industry, and then obviously further information about its performance and past earnings to growth ratio, that kind of thing. And you can go on and on and on, and there are oodles of information here about the company. Obviously that will help you interpret whether or not it's a particularly good investment for you to hold. Obviously here, like dividend, for instance, One of the things for me is that I would like to invest enough money in this company so that the monthly dividend payout is actually equivalent to purchasing a share at its current rate, so that actually every single month that goes by, if I reinvest that dividend, I'm buying another share without even really having to put any further money in it. Obviously, one thing I do have to be concerned with is obviously Simply Wall Street's analysis is that the dividend yield is, its reliability is only 3 out of 6. Obviously, that can fluctuate. So it's obviously something for me to be keeping an eye on and see what's going on. But obviously, as long as the stock price doesn't fall at the same time as the dividends are cut, then I've still got the capital in there. But this is the kind of stock that I would be looking to hold for a long time, and really, as long as it wasn't losing money continuously year after year, if it stays stable, that's fine. The dividend is really what I'm after. So I think all in all, it's pretty much as I was expecting it to be fair. Obviously, there are various anomalies. Current payout to shareholders is minus 238, so they're paying out more money than they're making. But I have real estate of my own, or buy-to-let properties, and some months, obviously, I pay myself more than perhaps what that property's earned because of cash reserves. It's a difficult synopsis, and then obviously if you want to go down a bit further, you can have a look at the sort of people that are running the company, whether they're buying shares back, how long they've been in the job, all that kind of stuff. So yeah, really useful app. So I hope you enjoyed that little overview of obviously the company's website, but also the Simply Wall Street website or app, which obviously gives you a real kind of in-depth knowledge or analysis of those companies. So realistically for me, I'm after the kind of dividend, and as I mentioned in the video, I'm hoping that if I can get the portfolio or the number of shares equivalent to purchasing actually one extra share per calendar month, because they pay a dividend monthly, that will allow that particular pot of money to grow and grow over time. And then obviously giving me more dividends and potentially more growth. I do feel that it's probably not a good place to put your money and get fantastic returns, Tesla to the moon type stuff. But obviously you have to have a kind of variety of spread, and I've got stuff invested with Neo and various other companies that I believe will be growth stocks. So I'm trying to sort of diversify myself a little bit here. So hopefully that video is really useful to you and will give you some good ideas of how to actually analyse particular stocks and really make your own decisions. And as I always say, I'm not FCA registered. I am just a guy on YouTube giving advice. So you must do your own research. These videos are really just for entertainment purposes only. So with that said, please do smash the like button. It really helps with the algorithm. Do subscribe. We're almost up to 50 subscribers. I would like to try and break that barrier. I think it's psychological. And then obviously we can then start to aim at the next one. And I really do still enjoy making these videos. And by doing that, by subscribing and liking and commenting below, you do help the video get out to a wider audience. And I've really noticed that sort of level of participation has really helped the channel achieve what it has achieved so far over the last month. So with that said, please do not forget to subscribe, hit the like button, comment below, do all those things, and I shall see you next time.